Bootstrapping and venture capital are two very different ways to fund a business, and each has its own advantages and risks. Choosing the right one depends on how much control, funding, and risk you're willing to take on. Bootstrapping means building a business using personal savings, revenue from sales, or small loans instead of seeking outside investors. Entrepreneurs who bootstrap their business retain full ownership and control, allowing them to make decisions without investor pressure. Bootstrapping forces businesses to be efficient with spending, grow organically, and focus on profitability early on. However, it can be slow and financially risky since the founder takes on all the responsibility. Many successful companies, like MailChimp and Basecamp, started this way, proving that businesses can grow without external funding. Venture capital, VC, is when startups raise money from investors who provide large amounts of funding in exchange for equity, ownership, in the company. VC funding allows businesses to scale quickly, hire top talent, and develop products without worrying about immediate profitability. However, taking venture capital means giving up control since investors have a say in business decisions. Startups that take VC funding are expected to grow fast and provide big returns, often leading to high-pressure environments. Companies like Facebook, Uber, and Airbnb scaled rapidly thanks to venture capital. Now, let's compare them side by side. First, control and ownership. Bootstrapping allows founders to keep 100% ownership and make all decisions, while venture capital requires giving up equity and decision-making power to investors. If keeping full control is important, bootstrapping wins. Next, funding and growth speed. Venture capital provides large amounts of money, allowing startups to expand quickly, while bootstrapped businesses must grow more slowly based on their revenue. If rapid scaling is the goal, venture capital is the better option. What about risk? Bootstrapping means risking personal savings and potentially struggling with cash flow. Venture capital shifts financial risk to investors, but comes with pressure to meet high growth expectations. If avoiding financial stress is a priority, venture capital has the advantage. Now let's talk about long-term sustainability. Bootstrap businesses focus on profitability and long-term stability, while VC-backed startups prioritize rapid growth, often at the cost of early profitability. If building a financially sustainable business is the goal, bootstrapping is the better choice. Finally, exit strategy. Venture-backed startups often aim for big exits, like IPOs or acquisitions, to repay investors. Bootstrapped companies have more freedom to decide their future, whether they want to sell or remain independent. If having the flexibility to run the business long-term is a priority, bootstrapping wins. So which one is the better choice? If you want full control, steady growth, and long-term financial independence, bootstrapping is the best option. But if you need large investments to scale quickly and are willing to share ownership, venture capital is the smarter choice. The best option depends on your business goals and risk tolerance.